All right, welcome back to the Wealth Juice podcast. I have a very good friend of mine, Phil Bach, on the show. It's actually Phil's second time of coming on the podcast. The first time we talked mostly about his story, how he's from the Miami area and he built this real estate portfolio and wholesaling and flipping business based out of Tampa. But today we wanted to cover a number of like topics that are kind of running the United States, whether it's the real estate market, what's going on with FinCEN, some of the Trump proposing this institutional ban for buyers, and I think that there's a number of things that Phil has some great insight on from being in the real estate game for 12-ish years now. So Phil, I appreciate you coming back on the show. This will be fun.
Yeah, Corey, thanks for having me, man. It's an honor to be on here. And yeah, it's funny saying that out loud. 12 years in the game. I feel like a dinosaur in this
Yeah, it's fun.
business.
Yeah, and I kind of threw that number out there because I feel like the last time when I met you, I feel like you said 10, and now it's been a few years. Is 12 accurate? Is that how long you've been doing it?
Yeah, 2014
Yeah.
is when I started. So coming up on 12 years.
Love it. Well, I think you're qualified enough to talk on a lot of these topics now. So we're going to get into it. And I really just wanted to have like a state of the market type of episode. I think that's useful for people that are in really any market. But one of the conversations that you and I had about a couple months ago is that you mentioned my 2025 was kind of tough, just business wise. And you said the same thing. You were like, yeah, 2025 was rough. Like it was hard to get deals to pencil out, wholesaling, flipping, et cetera. And then you texted me the other day and you were like, dare I say we're back? Like 2026 has been better, right? So give me like a rundown of, first of all, I guess we should back up a little bit. And just for people that don't know you, just tell us what you do. I kind of gave it a little bit high level, but what you do. And then we'll get into that question about like the difference in 2025 and 2026.
So my company, in the most basic way of putting it, we just buy and sell houses. And that's whether it's we're finding off-market deals or we're connecting investors with deals or, we don't do a lot of wholesaling anymore, but I'm more so, we're just constantly buying houses from other wholesalers, or I have my own direct-to-seller campaigns that we have going that are doing really well right now. So every facet of the business we're involved in. I do hard money lending and conventional financing. So whether I'm on the acquisition side, buying houses from sellers, or on the flip side, once we fix it up or we put it on the market and we're selling houses and working with buyers and their agents and their lenders, we kind of see literally everything that goes on from A to B in this business. So obviously, starting in 2023 and 2024 and 2025, the market really hit the ceiling. High interest rates really put a damper on things. And I mean, I've talked to so many guys that were struggling in 2025 and we're just losing money, and I lost money on a couple deals. And it's really, that was like the theme is like, okay, here's the changing market. How are people responding? How are people fine tuning their business and adapting to the new market? So 2025 wasn't bad, but it wasn't great. And I think we caught the tail end of the high interest rate effects. And slowly but surely, at the end of the year, buyers started entering back in the market as rates were getting closer to the 6%. That's where that brings us to 2026, where I think it was a scorching start to Q1. Rates dipped right below 6%. Buyers started entering the market again. Builders started getting confident again. And it's funny when you look at the whole ecosystem of the real estate market, there's so many external factors that basically go into what people decide to do ultimately. It's no different than stock markets. People hear news, they get scared, and stocks go up and down. And that essentially has an effect on mortgage rates and consumer confidence buying houses. So things started off really well in Q1 of 2026 with the lower rates. And it's oversimplifying things, but that's essentially what the real estate market comes down to, is affordability and interest rates. And once affordability starts to go down, once affordability increases with lower rates, then you see more buyers into the market. As such, demand goes up and inventory should go down. Now, of course, that leads to what goes to higher prices, which is what benefits investors like you and me and people who are already locked into their homes. Your equity increases. So it's this whole, seesaw back and forth. So things start out really well. Q1, I had a bunch of houses that were sitting on the market Q3 and Q4 that eventually, this was like 60, 90 days on the market, not really a lot of activity, not because we overpriced it, just because in certain neighborhoods, certain cities, there really wasn't a ton of demand because of the rates. I got to clear off all those properties. All of a sudden, we had lots of interest towards end of December, early January. We sold a bunch of houses since then. Things were really, really looking good up until this last month. Then we get some global volatility. Obviously, the war in Iran, oil prices are basically the biggest domino to fall that really just kind of puts everything else into chaos. So that's where we're at right now. We had a really good Q1 start. Q2, which starts next week, it's a little, nobody really knows what to expect. So I haven't seen like a drop off in demand or prices just yet. Again, it's still early, and I've cleared out basically all of our inventory. So I do have a new wave of properties where we probably have 15 houses that we're either under contract on, or we're in progress, or getting ready to wrap up and put on the market. So we'll have a pretty good barometer of what is going on, in the Q2 market in the midst of the Iran oil stuff. And really, we could take a deep dive, but how oil prices really affect everything else in the supply chain and how that eventually ties to mortgage rates.
Yeah, I would love to actually go there. Before we do, I was going to ask you, based on like hyper localization and Tampa, St. Pete, the Florida, how much of the 2025 issues do you think stem from the end of 2024, like weather, hurricane type stuff? Because in October of 2024, if people don't remember, there were two hurricanes that came through. One really affected, Helene really affected not just Florida, but Georgia, Augusta, and even North Carolina significantly. And then, well, no, Florida got hit by both, really. It's just Tampa didn't get hit by both. So I'm curious, like, how much of the slow 2025 do you think had to do with that? And then we can get into some of the oil stuff, because I do want to see how that trickles down, and then how real estate kind of trails that too. Because you were mentioning like, we haven't seen it yet. It's like, I feel like some of that is coming months. Like it kind of falls behind what's happening with the war in Iran and everything.
Yeah, so Florida is really interesting in that it's just one state out of 50, but it's a good barometer for what's happening overall. Florida is very volatile. You have big swings and you have the highest of highs, but when things get slow, you get some really low lows in some markets, and we're seeing that in a lot of Southwest Florida markets. But yeah, like we said, Florida is really interesting because you have people there's so much out of state activity. There's people buying vacation homes. There's people investing remotely. They want their beach homes, or they're buying Airbnbs. And then you have institutional investors, hedge funds that are buying up properties. And we'll get to that too. So Florida is, while every state's different, I think Florida is a good picture of what's happening overall in the economy. Now, in that question, how much of 2025's slow real estate market can be attributed to what happened in 2024? Yeah, Tampa and the Tampa Bay area got a double whammy from both hurricanes. You had coastal flooding in Hurricane Helene, and then you had rainwater flooding in Milton that happened more inland. So that really sucked. So houses that were on the market, it basically caused a whole freeze out of the real estate market in Tampa, because I know I had a couple properties in St. Pete. Half of St. Pete flooded, essentially.
We walked through one of your flooded properties, and I think it was South Tampa, right?
Well, yeah, that one, make sure to get a flood disclosure next time you're buying from
that's
wholesale.
a story for another day, I feel like.
Yeah, we can get into that. But yeah, the market was pretty much frozen out for, I don't want to call it 6 months, but that's what it felt like. I had several properties that I had listed right at the time of the hurricanes or right after the hurricanes, and there was just zero consumer demand, because either everybody was still dealing with the fallout with their own homes having flooded, or everybody was so spooked, and it was just a mess, man. And it really sucked. I think that lasted through all of 2025, where people were spooked. I know flood zones now, people are really paying attention to that. Flood insurance costs have spiked. Now, the national picture about the national narrative that, oh, Florida insurance prices are out of control. That's another thing that we can discuss fact or fiction.
So if you've ever tried getting a mortgage, which I'm sure many of you have, you know how daunting and discouraging it can be of a process. The slow process, paperwork, being told no without any real explanation. One time we were even told that taking out a home equity line of credit on an investment property wasn't even possible. So that all changed when we were introduced to Neo home loans. What makes Neo different is literally how they approach lending. They're not just checking the boxes, they're legit problem solvers. They look at your entire financial picture and explore multiple angles, literally until they find a strategy that works. They helped us reposition our portfolio, pull out lines of credits to scale, and structure everything for long-term growth. And on top of that, their rates were some of the most competitive that we've seen. They just literally did whatever it takes to find a solution. For us, Neo has become our liability advisor. The same way you have a financial advisor on the asset side for the liabilities. If you're serious about building wealth through real estate, it's worth sitting down with them and getting your lending strategy dialed in. If you want to book a call with them, click the link in our show notes. Their team is unreal, but don't just take it from us. Find out for yourself. I can tell you from like my standpoint, because I have a property that's in a flood zone in Tampa, and now keep in mind, my property did not flood. Luckily, like
Yours
it
was the
was
only one on the street.
only one on the street. Dude, it's I don't know who was looking down on me, but the only one on the street didn't flood. My insurance stayed the same in the last 2 years. Now, the thing that I was keeping an eye on is because I bought this property as a short-term rental to try to make some cash flow, but to enjoy it. But really, that's not the purpose. I bought it because I'm watching what's happening in South Tampa. I'm like 10 years from now, 15, it's going to be worth significantly more. And there's $2 million new construction homes going up the block over. But I noticed that there were some flood properties that got sold for $300,000, $400,000, which drove the quote unquote Zillow Redfin listing of what they think my property is worth down. But then I just saw another property across the street from mine, I think directly sold for like 640, 650. I could be wrong on the exact number, that I think was flooded, rehabbed, rebuilt into something really nice, and then sold. So I think it really, to me, from kind of an outsider looking in with some investment down there, I have seen, it really did take this almost 18 months to be like, okay, we're settled in. And then we're, knock on wood, for 2026, but there were no storms in 2025. And it really did seem like this crazy outlier year that I always tell people, it's like, look, it's the price you pay for living in paradise. As you can see, Phil's background versus my background.
I had to rub it in a little bit today. 78 and sunny.
Beautiful down there. Yeah. And I'll make my way down at some point soon. But so back to, I mean, I think you answered that question, which is great. But back to then, I want to get into the oil prices. And because I don't think people, and I might be even wet behind the ears when we talk about this, equate oil and driving up oil prices to how does that affect the real estate prices, market, et cetera. That's all happening in real time. Prices for gas were $3.10 in my town, and they're $3.99 a week later. So like, okay, there's a supply chain issue, and there's an issue with how that affects real estate. So I'm curious on your take on how you think the trickle down effect works.
So contrary to the headlines, nobody can really control interest rates, and it's not Jerome Powell's fault. It's not the Fed's fault. It's the Fed's job is to monitor inflation and basically limit inflation as much as possible. So what happens is when inflation chances go up or inflation goes up, rates are going to go up. That's economics 101, Keynesian, any kind of economics. That's basically how it works. So you can't just flip a button and say, hey, rates need to go down. So everything was doing really well. We were, prices were overall down, whatever, the eggs, the individual grocery prices, debatable. But for a minute, it really, the Fed did their job in basically suppressing inflation. And as a result, interest rates were able to come down sub 6%. And that's where we saw a quick little boost in the market. So what happens now with the issues with the oil? And when obviously this is a whole macroeconomic discussion, but basically what happens is the Strait of Hormuz is closed, or basically all that oil's piling up. That's the hotbed of the entire world's oil production, essentially. And it's getting stuck and constricted, and they can't get it out. So that's what causes the prices to skyrocket. Oil is just involved in literally every supply chain possible. So everything is presumably going to go up as a result. So that's where the 10-year treasury, which is basically what the mortgage rates are tied to, that's going to keep going up. And as long as all this stuff keeps getting more expensive, rates are going to rise to basically counteract this new inflation that we're going to be seeing because of this. So that's where it's like everything was going really well, and then we just had to go do all this stuff, right or wrong. It's not even getting into a political debate about it. It's just what's best, what's happening for our economy, what's going to help out our economy. Certainly in any situation historically, war is not really going to help out. So hopefully it's just a short-term thing, but that's where we're at right now for real estate professionals. Everyone was like super hot and excited last couple months. Now expectations are a little dampered. It's a shame because we had a lot of momentum in the market. And now it's like we might lose that, or nobody really knows. And obviously, every day the stock market's just like, oh, or trade talks are increasing. Okay, stocks are back up. And then it's like, oh, we actually never had any conversations about trade at all. Stocks are back down.
Yep.
So it's just one of those things where if you're looking to buy a home or you're an investor, it's just like, look, you can't sit there and stare at your Robinhood account every day and worry about the little ups and downs. And essentially, it's the same thing for interest rates. So I tell people, it's like dinner table conversations that everyone has. Oh, how's the market? Is now a good time to buy? That's a question that is different for everybody. That's an answer that's different for everybody. If you're ready to buy and getting a rate at 5.8 versus 6.25 doesn't really affect you, still do it. If you're holding out for a smoking hot deal, then hold out. But it does affect the people that only qualify at a 5.9% rate, whose rates now bumped up to 6.25, 6.5. That's where you see people get priced out in real time. That's where the inventory now sits in real time. And people who would be buyers or prices, houses that should sell for, X are now, okay, they're limited to 5% drop or something. So
yeah,
that's essentially the trickle down of all of this.
And I can give a good example of how this has happened recently. So in Philadelphia, we had I just helped somebody sell a property that was an investment property in South Philadelphia, and they got an appraisal back in 2023 that said that their property was worth $540,000. They came to us. I ran an analysis on it, and I said, guys, if you want this to fly and you want to get out of this deal and you want to sell it, we should list it for $499. I'm sorry, $449. So 80 grand less. And kudos to them for saying, look, we want to get out of this deal. I totally respect the work that you've put into this. Let's do that. We sold it for $459. So it went $10K over asking. Now, was it the best return? That's the whole thing, because maybe they bought it I think they bought it in the threes. So they didn't get as much money as they wanted ultimately, but their property sold and they weren't relying on a 2023 appraisal. I think what I'm seeing kind of macro wise, I was reading something about Austin. Austin was like similar to Tampa, was like one of the hottest markets for like 4 years. And actually for now going on 3, it has cooled significantly. And I thought there was a drop of like 10, 15%, but it's more like 20, 25, almost 30%. And these sellers are holding on to prices in 2021 and they're not budging. And I think Tampa was kind of in that range too, not quite as hot as Austin, but it was in the top 5 of fastest growing markets from like, I don't know, I guess you would say 2015 to 2021 or 22. And now all I'm seeing about Tampa is like, oh, it's declining, rents are decreasing. Are you seeing that happen? Or is it kind of broader news that's not as micro as somebody who's like really in it?
So 2 things can be true. House values can decline, but that doesn't necessarily mean that it's a market crash or market halting. And that's kind of, what goes up must come down. When you accelerate pricing at such a high rate, I mean, dude, it was like 50% over 5 years. Of course, you're going to eventually, level out. So yes, when you look at the zoomed in micro data, somebody who bought a house in 2023 and now they're trying to sell 3 years later and the house isn't worth that much. Yes, that is going to look like that example you just showed. That's what, a 20% drop in value from their 500 some odd appraisal to 420 or 430 or whatever. that is a big change. But when you zoom back out, okay, well, that house was only worth 300 5 years ago. So there's still the year over year on an average basis is still improving. It's still a positive net gain. It's just, when do you want to draw the line? If you look at what your house was worth last year and it's dropping, you're not going to say, oh my God, my house dropped 20%. You have to look at it historically. And so I think that's what a lot of the headlines capture. I do think Austin is probably not doing great right now. And I see that in Tampa too. Now, does that mean that the market's crashing and people are getting foreclosed left and right? No, but what it means is you had a lot of people, and I see it every day, people are calling in wanting to sell their house, but their house is either worth as much or less than what they paid for it a couple years ago.
Well, and even the case for me. So, like, as an example, I bought my house for $550,000. If I were to go to sell it today, I put renovate. I did some work to it, but I don't think it would be more than, this was 3 years ago. I don't think it'd be more than 600 ish, 615 maybe. It has a pool. It's a nice house, but like, I would not, it would not be in my best interest to go ahead and try to sell that property now. Like, and I've seen that happen. I've been like, oh man, like, you know, you don't, I don't pay attention too much on Zillow and Redfin, but I'm just looking at like what they're saying. And it in their eyes, they don't know that I renovated it, but it hasn't improved. It went up from 500 to 560 or 550 to 560. So I'm seeing that exact thing. And I think that's something to keep in mind when working with buyers in Philadelphia. And they're like, is it a good time to buy? I get that question all the time. It's like, I think the real question is, it should be turned back on the person. Is it a good time to buy for you? Right.
Correct.
That's
exactly,
I think, kind of what you're saying.
And also, you know, for your house specifically, your estimate is getting affected by people who are selling their homes as teardowns or houses that flooded. So, you know, there's so much that goes into it. I think generally speaking, you're in such a good part of Tampa and you're close to the water that demand is always going to be solid over here. Where I'm seeing a lot of this specifically are newer construction communities. So every house is basically exactly the same, which is helpful, but also not great, because there's nothing about your house that really stands out, because everything's the exact same square footage, unless you're going to go out of your way to really, you know, deck it out. More or less, your house is worth what the house next door is selling for. And so that's what really, I think, trips up these people in these communities. They bought the houses for, you know, basically the peak in 2022, 23, 24. Now they're going to sell, but they don't have any equity. And then when you sell, you got to factor in your closing costs, your realtor costs, all this stuff. And I see people that are selling their houses subject to, obviously that's a big thing. But they're basically trying to get out because they can't sell otherwise. They don't have the money to pay off their balances. And that's where things start to pile up, where inventory piles up, people can't sell their homes. That's where people start to get in trouble. So you are seeing an uptick in delinquencies and foreclosures. Again, going back to what you read in the headlines versus what's actually happening, people will say, oh my God, foreclosures are ticking up at a huge rate. Well, comparatively speaking, foreclosures have been at like an all-time low these last 5 years. So yes, a 10% increase year over year sounds like a big red flag, but when you look at it, it's still nationally at like 2 or 3% or something. It's people have to understand that the market is basically just leveling out in a lot of places. I don't want to call it a crash because, again, it just comes down to there's people that still have so much equity. People are still locked into their 3 or 4% rate, so they don't have a reason to sell or buy or move. There's just so many factors into it. So, my opinion, there's no red flags right now. There's stuff to be wary of. Obviously, as an investor, I lost money on a couple deals last year. So, you know, I know exactly what to look for and what to stay away from. And I see these sellers that are calling in, they have no equity and they're basically, hey, I'm just happy. I need to get out of this, whatever. But that's always going to happen. You know, that's going to be present in any market, no matter what people pay, no matter what their houses are worth. There's always going to be distressed sellers. So it's just, I don't know. Like I said, moving forward into Q2 doesn't help with the oil stuff, but relatively speaking, in terms of the health of borrowers and buyers in this market, you know, everyone loves to point to 2008, but the safeguards are still in place. Like, you still have to qualify, you still have to have a job, you still have to have all these checkpoints to obtain a mortgage. So on our end, the real estate end, hey, we're doing okay. We're doing our job. We just need the rest of the economy to cooperate, so we can kind of get back to those lower rates.
Hey, let me pause the episode real quick. Let me know if this sounds like you. You're making six figures, you're climbing the corporate ladder, investing in your 401k and your Roth IRA, and maybe even a brokerage account. But deep down, you're asking yourself, is this really it? Like, am I just going to do this thing for the next 30 years and hope to retire in my 60s? That was exactly us just a few years back. We were curious and excited about real estate, but overwhelmed and without a roadmap. If you fast forward to today, we've built a portfolio of over 80 cash flowing units and grown our net worth to over $2 million. We made it our mission to help busy professionals like you take that same leap and start building generational wealth for yourself and your family. That's exactly why we created the Wealth Juice Inner Circle, a private real estate investing community designed to help you get your first rental property under your belt in as little as 90 days. Inside, you'll get direct access to us, our full investing network, private off-market deals, and our exact playbook, and a community of investors who are closing deals every single week. That first property changed everything for us. We always talk about it. It was the true foundation for building generational wealth. And honestly, if we had access to something like this when we first started, we'd be 10 times further along by now. So if this sounds just like you, click the link in our show notes and schedule a call with me. Yes, me. I'll be taking the calls. We'll go over your goals, map out a plan, and get you ready to close your first deal. Let's get it. I would argue with the way that some of the things that I've gone through with mortgage lenders, it is difficult. I think they make it very difficult, and you know what? I think that's a good thing. But it's difficult to qualify for mortgages. So I don't see any signs of 2008. Now, keep in mind, I was in high school in 2008, so I didn't live through. I think you were too, right? So I didn't live through
playing Call of Duty,
exactly,
Modern Warfare 2.
So we're not saying that we know everything that happened in 2008, but like from a macro perspective, there's not those safeguards. You're correct, they are in play. So one of the things I wanted to mention is that's why I think these conversations are so important, because when you read headlines, I always think about this. When I'm reading a headline, I'm thinking, okay, why is the headline being created? Well, who's the publication that's creating it? Well, what does that publication do to make money? So I click on a headline and I realize that my clicking on this brings them advertisement dollars. And it's not that it doesn't matter if it's true or not, because there has to be, you would think, some level of truth to it. But the reason that you're clicking on it isn't for the facts. It's for dollars in the pockets of the media producer that is creating it. So it's like, okay, if all you do is look at headlines and you don't listen to conversations like this, you would think it's a terrible time to buy. The war, I gotta stay away. I think the smart people are thinking, okay, let me have these conversations and look deeper.
They want their headlines, they
exactly.
want their clicks.
Yeah. So one of the other topics that we wanted to chat about here is FinCEN, and this FinCEN stands for Financial Crimes Enforcement Network, and this is something that's new. I'm learning about it. I think you know a little bit more than me, but it's new for everyone, right? So I just went through the situation here. I was helping a buyer, a member of our community, buy a Burr property, and he bought it from an estate sale, and there were 4 sons and daughters that were selling it, and he was buying it through an LLC. So he had to go through this FinCEN process. But then halfway through, the lender said, "Oh, you actually don't have to do it because it got deemed unconstitutional," et cetera. And I was like kind of trailing this conversation, trying to figure out what was going on because it was very new. But basically, what it's doing here is it means that you have to if you're buying a property through an LLC or trust, you have to report the real human being who actually owns or controls it. And this is trying to protect from, I guess, like illegal shell companies. I'm not 100%
money
sure.
laundering.
Money laundering, right? So, what has your experience been with this, even in the short period of time that it's been like a thing?
I'll keep it PG and refrain from my real thoughts on it, but it's a load of crap.
You can give us some of the real thoughts.
Yeah, it's garbage. It's I think it's a racket. I think FinCEN isn't charging for this, but here's what's the problem is now. Title companies are being forced to collect this information. They don't want to do that because that's extra work for them. It's a lot of work. They told me it's like 45 minutes to an hour to file it. So now they have to hire third-party companies to do it for you. And then who pays for that? Me and you, the buyers or the sellers or whoever, So, and then there's no real guidelines on it. Everyone has all these questions. Nobody knows what it costs. So I had a title company want to charge me $400 to file it when another title company didn't charge me anything, and another only charged me $100 for the third party service. So it's just this whole thing that's just been dumped on everybody. Nobody wanted this. Nobody voted for this. I don't think the intent is bad per se, but I do think there should be maybe a certain threshold. You know, people buying $100,000 house, $500,000 house, those aren't the guys that you're going after. The guys that you want are maybe the $1 million and up range. So I think on one hand, if I can be constructive, give it constructive criticism. Look, if you're going to go after these people, go after the right properties. Two, it's repetitive. I've had 6 closings now where I had to fill this out. It's all the same information. It's still me on every transaction. So it's just, I don't know where this came from. I know there was talk of this last year where, but the difference was you only had to file one thing for the year and that was it. So I'd prefer that. But now it's like, oh, we have to do this for every closing. It's created more paperwork, more bureaucracy. And who is it helping? It's not helping you and me. If it's helping the government do their jobs to find criminals hiding money, well, they can do that on their own time, you know?
Yeah, I know. I agree with you. And also I feel like what it's kind of doing is it's proposing to like pull attorneys into these deals too a little bit more. And that anytime, no, obviously attorneys have their, like I've bought properties with attorneys and without real estate agents, but I'm just saying like anytime you have that level of like, it's a deeper thing, and it just creates like, oh, whenever an attorney's involved, it feels like it's like, oh, it's me against you now. It's not like we're trying to do this together. And maybe that's just a personal problem that I have, but I just like, you know, there's already enough red tape to try to get a transaction done. It feels like it's just overbearing. And I don't know how you differentiate between whether or not somebody would be money laundering in a $200,000 property versus $1 million. But I hear exactly what you're saying. They're probably not buying a $275,000 rental property.
It's not on anybody's list of concerns. It wasn't on my ballot. And look, I don't get political. I'm an equal hater on whoever's in office. It's fair game to criticize for me. So for just a free market administration, this is not very free market. This is not pro consumer, and it just adds more to the consumers' bottom line and creates more work for everybody else to help the government do their job. No, that's not cool with me. So anyway, so here's what's happening with it. So it got struck down in Texas, ruled unconstitutional. So technically speaking, it's on hold. It's not required statewide right now. But what I was told from one of my title attorneys, he says, well, if FinCEN appeals it and gets it back in place, there's a real possibility that FinCEN is going to ask every title company to go back and get the information from the closings that happened in between now and then. So that creates a nightmare scenario for title companies, because then they close a deal 3 months later, they have to go back and get somebody's information. Let's say that guy doesn't want to cooperate, or he's not obligated to, really.
Yeah.
Then the title company's on the hook for all the fines and whatever. So now, people are basically, do we still collect this? Do we still charge? It's a complete waste of our money and government resources. And so, it's repealed right now, but we don't know if it's going to get kicked back into effect. So
was it pending for a while? Because I like, to me, when they say like it's kicked back into effect, I'm thinking like, is there not like, oh, well, you have until like it's going to go into effect on May 1, or it's going to go into effect in June 1. Like for me, it was in the middle of this transaction. I hadn't even heard of it, and maybe I need to do some more research. But I just like the title company came to me and I was like, I've never heard of this. And I guess it just got implemented immediately, or was it, maybe I'm just.
It was like earlier this year or later last year was when they brought it up. But again, they had the same problem last year, where they wanted to collect all this information and it kept getting contested, and then it would get repealed, and then it was back in effect. And it was this whole back and forth until it was totally off. Trump stepped in and said, hey, no, this is ridiculous. But then mysteriously just popped up again. Now it's even worse because we have to do it for every transaction. So I don't know, again, who asked for this, who voted for it. I don't know where it came from, but
it seems that a lot of things happen that we don't know if we're voting for. So, but that might just be the world we live in. But speaking of voting, so this happened, I think it was 3 or 4 months ago. Trump had this, it was probably just a tweet. I don't know if it was something that it was more like formally in writing or anything, but, or I guess a tweet is formally in writing these days, but he was looking to ban institutional buyers. So the question that we would have here is, what is an institutional buyer? And then we were talking about this. Does it actually create affordability for the average home buyer? Or is it really just like, oh, I feel like this looks good on paper? The research that I've done on this is, I believe anyone that would be looked at as institutional, I think it's only like 3% of the homes that are being purchased in the United States. And that number could be swung, I think maybe 1 to 5. I don't know how you would determine it, but it's not as many as you would think. So does that help? Do you think it helps?
So basically, where this all stems from is hedge funds were super active from 2020 to basically 2023, 24. And they were buying a lot of homes. Now they were buying a lot of distressed properties because I sold them a ton of homes. And does it take away from what other people were wanting to buy at the time? Yes, because rates were artificially low at 3 and 4%. And there's just, no matter what, there just was not enough houses for the amount of people that those low rates created demand for. That being said, that's all. I haven't sold a house to a hedge fund in years. All the hedge funds that are even still operating, a lot of them shut their doors or whatever. They sold their portfolios because, again, they're no different than you and me. They're investors. The market changes from 2023 to now affected them adversely. They couldn't keep buying and they couldn't keep up with what was going on. So it seems, one, if it is effective, it's a Band-Aid for a problem that was already fixed by the market years ago. Two, there's several clauses and fine print in that proposal about, what is it? It's got to be an institution that owns over 100 companies and per entity. So there's a lot of sidestepping that can be done. But two, the other provision was something like, oh, it's only applies to companies using institutional funds. And that's very important. So these companies are buying these properties cash. They're not getting a Fannie Mae mortgage. Maybe they're turning around and getting portfolio loans from Wall Street. That's probably where everyone's pension funds are going into, actually. But that provision alone eliminates the biggest buyers. So they're still free to buy houses as long as they're not using federal funds. I just think overall it's something that's more like lip service. It's like campaigning on, hey, lower rates, more affordability, no more big bad housing companies buying up houses. Because I still see that. I see Florida politicians are running on stuff like that. Like, we're not going to let BlackRock keep buying up houses. Well, they aren't. Like, they're not doing that right now. They're not doing it at a large enough scale to actually price anybody out. I mean, dude, there's sellers right now. They would love if somebody came in, an institutional buyer came in and bought their house. So there's people that are actively hurting to sell houses in certain markets. So, as long as that problem persists, eliminating, a small percentage of buyers from the market, basically out of lip service, in my opinion, it's not going to do anything.
Yeah, and I think in theory, now maybe this is just headline stuff too, and that's the whole point, is that it wants to make people feel good. I think that's what you mean by lip service, right? But like, in theory, it is a good thought. Like, I don't want the millennial that is a peer to me that has been saving up, and they're not in real estate investing. They just have a job and they want to buy a home. I don't want them to be prevented from doing that because of BlackRock, right? That doesn't make any sense. But what you were kind of peeling back the layers here is that this isn't actually going to help. And is it even constitutional to stop them from doing it? I don't know. I don't know the answers to any of this, but I did. This actually reminded me of, you mentioned, just talking about Florida. Ron DeSantis, the governor of Florida, is talking about removing property taxes. And I was listening to a interview of him the other day, and what he said, like him, hate him, whatever, like, it really made a lot of sense to me. He was saying, when you go buy something from the supermarket, or you go buy something from a store, you pay tax on it when you buy it, but you don't continuously pay tax on it after you've already paid for it. Now, if you have a mortgage on the property, I don't think the proposal is that if you still have a mortgage that you're not going to pay property taxes, because technically you don't own the property, the bank does, until you pay it off. But after it's paid off, you then still have to pay property taxes. Everyone knows this, to the government. And my thought process is, I think that's BS. Now that I really think about it, why should you after you paid off? Now the question is, can you eliminate property taxes for people that are owner occupied while you still have the mortgage? I don't know. I don't think that's even on the
I don't
table.
think that's I don't think that's part of the proposal.
Okay. So what are your thoughts? Like, are you in agreement with that?
So from my understanding of it is that they're proposing to eliminate property taxes specifically and only for owner occupied homes, which sure, I would love if I didn't have to pay property taxes on rental properties, but
You
I
don't have any
understand.
paid off ones, do you? Right?
Well,
Like,
no,
yeah.
but whether it's leaned, well, to address that comment, just because I have a mortgage on it doesn't change whether I own it or not. Just
Right.
because the mortgage company, they don't own your property, they have a lien on your property. So if you don't pay, but that's an agreement between you and them. If you don't pay, they have a right to your house. It doesn't mean they own your house. Whereas property taxes, I own the property, I paid for the land. It's almost like property taxes create a lease to the local municipality. So yeah, of course, I'm a free market enthusiast. So I don't think, but I do understand that there is a need that I want my kids to go to good schools. I want my community to have structural integrity, and I don't want to have lead water in my drinking
Firefighters
pipes,
and all
like
this stuff. Yeah,
stuff like
exactly.
that. So
Yeah.
I understand there is a middle ground there. I'm okay with the idea. First of all, I love the idea that I can get a break on my property taxes. So I believe the proposal that's passed is it's got to be your own owner occupied home. So investment properties, especially Airbnbs, whatever, they're still going to collect property taxes on those. And I could be wrong. I got to just double check because I know they just
I think
passed
you're
it.
right. I think you're right. And this is passed. This is passed.
Well, it passed the legislation, but I think I don't know if it's something that still has to go on the ballot for like the next big vote. I got to find out more about that. So I'm all for that. And I think it's fair. Hey, if they want investors, sure. If I'm making money on my investment property, I'm happy to pay my property taxes. I'm not happy, but I get it. And then even then, so owner occupied homes, you still don't get a full break from paying the property taxes, but I believe it's limited to what goes towards your schools and whatnot. So basically, it's like almost a 70% or 65% reduction in your property taxes. So if you pay 10 grand a year, you can expect maybe you're only going to pay 3,500.
Now, is that when properties are paid off? Is that when it's paid off? Is
No,
that the proposal?
again, I'd have to double check, but that's the first time I've heard of anything. I know that's a big talking point, and that's a good case to make. Is like you have senior citizens who sat in their home for 30 years, their home is paid off. Why are they still paying money on property taxes?
I think that's the biggest
right.
argument that could be made. I guess is what I'm saying. I agree with you that I don't think if you can eliminate them, great. But I think the biggest argument for why the heck are they still paying them would be after it's paid off, But you're right. It's kind of two different. It's not even the same transaction. It's just because there's a mortgage on a home doesn't mean that you don't own it any more so than when it's paid off. It's just that if you default, you can get the home taken, right?
And also, so the big counter argument is, what about revenue? How are we going to raise our money? Well, I get that is a big question, big concern, and part of it is, well, I'm okay with paying extra sales tax. We don't pay a state tax in Florida, we don't pay a city tax in Florida. So I don't want to pay more taxes. I'm always a big believer in fiscal responsibility. But I think what people don't realize is like how much we already pay in taxes with specific to housing. And I know this, buying and selling a lot of houses, I'm paying what's called documentary stamps on every closing. That's basically a fixed percentage of the purchase price that goes straight to the local municipality. So Hillsborough County, every time I buy or sell a house, I'm paying doc stamps on the sale. So that's a tax in and of itself. Then I want to get a mortgage on the property. I'm paying taxes based on the mortgage amount that goes straight to the municipality too. So it's like, don't even get me started on all the other stuff that we pay. But those are the two biggest things. People think that, oh, well, how are we going to raise money? Well, they're already getting a ton of money on the sales of properties, and it's happening every day. I've sold 10 houses already in the last 2 months. I paid doc stamps on every single transaction.
Yeah.
I probably paid millions in my career that go to the local courthouses. So there's ways to do it. It's just like it's a complicated subject, and obviously the people that don't own homes are going to be upset, and I get that. And then they're saying, oh, well, it's an unproportionate tax then, because then poor people have to pay whatever increased sales tax, or they're paying an increased portion of their income. But I don't believe that just because you own a home, you're on the hook for higher expenses. We all use the same roads, we all use the same schools,
Yeah. And now I think that, I mean, owning a home, quote unquote, the American dream, but I know a lot of really, really, really wealthy people that rent. It's just real estate's not their
Yeah.
thing, Now, I don't necessarily agree with that route, but that's not my life. That's how they want to
It's
do
not
it.
for everybody. I'll say
Exactly. Yeah.
that. I get people that call me, and it's a lot of maintenance, it's a lot of work, and people just say, hey, I can't keep up with the house, can't keep up with everything. And that's what creates opportunities for investors.
Yeah, exactly. And we are in this is kind of why one of the big reasons why I really do like the functionality of the United States, because having each state be able to decide on some of these things, I think you can make whatever argument. This isn't political. I don't really care. It's just that I think that it's a breath of fresh air that if Florida thinks differently than PA, that can get implemented, like I think, and yeah, no, it's not super easy to pick up and move across the country. I'm not saying it is, but if you needed to, you could, right? And like, I think that is like, there are things like Delaware not having state. I don't think Delaware has sales tax. And then like Florida not having what you were saying is no state income, right? That's
No state income tax,
right.
right?
So
That's
that
always
is
a big draw for like athletes. You hear about that in free agency. Two teams have the same offer. Well, they're going to go to the Florida team because they're basically paying. What are the typical state taxes, like
well,
5?
like so it's 6% in PA, but in Philadelphia, I live in Philadelphia, so it's another 2%. So it's 8. That's 8%. Yeah. So like I don't make $1 million.
So you guys got to pay state tax and city tax and property tax. That's
Yeah,
crazy.
I know it's crazy. The Northeast, man. I got to get out of here.
Yeah.
But anyway, does it affect you on if you're making 100 grand? A little bit. It does affect you if you're making $1 million. Yes. And then obviously these big contracts of like,
What's up, man?
yeah, it does. So I really like the conversation. And I think that it's cool sometimes we talk about stories on our podcast a lot. And we talk about, how are you specifically buying this property, but to give like a full picture of what's happening in the market, and just like macroeconomic wise, and like what the difference is. Will say like the market's hot, the market's cold. Well, what's that mean? That's this conversation. So
It's perfect for a dinner table conversation. Every time you meet with people and they're like, oh, how's the market? Well,
here it is. Go listen to this podcast.
Everything in here. Dude, we should talk about that Chat GPT guy. Do you hear that crap?
No.
Like, this guy sold his house with Chat GPT. He didn't need a real estate agent.
Let's
talk about fact or fiction. This guy was a real estate. He's not a real estate. He's a contract attorney. And he's just doing it for shits and giggles. And basically it told him to list it for lower than what it was really worth. And that's why, look at the multiple offers. So,
he was an attorney. Actually, this is good that you brought this up because I heard about it, but I didn't look into it. So he was an attorney and he sold this property, but he had experience selling properties as an attorney before. Is that the
contract attorney?
Okay, so
contract law.
Right. Okay, so he
those are the biggest. That's the biggest number one thing is like most people selling a house, they don't understand the contracts. And let's say you wanted to circumvent a realtor. And look, for sale by owner, it's been around forever. Nobody's ever saying you can't sell a house without a realtor. Because I agree, that's not true. You can. Usually you want to do it with experience, or maybe you have somebody holding your hand. But we've never said, you can't sell your house without a realtor. But statistically speaking, your house will likely sell for more with a realtor. Or on the buying side, you're less likely to encumber headaches after you bought the property. Maybe you know what to look for, but you have a real estate agent explaining the inspection report, just things like that.
It comes down to trust at the end of the day. And like Look, I hear a lot of things online. I would never pay for a real estate agent, blah blah blah, all that stuff. That's fine. I get it. But you can do for sale by owner. But the only time I've ever had experience with this, I bought direct from sellers. But have you ever tried to sell a car? Like, if
Oh,
so it's different than real estate. I would imagine it's probably easier. I don't know. Maybe somebody out there that's listening could correct me on this. But I've tried to sell a car, and I'm like, dude, I would rather. Like, I remember I had this Mercedes right out of school. That's like C class. I thought it was so cool. I wasn't cool, but I sold it a couple years later because I was like, it was too expensive for me at what I was making at the time. And I remember I was like, all right, I'm gonna get 15 or 16 grand for this. I'm gonna try to sell it. And I like couldn't figure out how to sell it. And then the dealership was like, we'll give you 12, dude. Just take. And I was like, you know what? For the hassle, the 4 grand, just take it off my hands. So I'm saying it's not the exact same thing, but it's sort of an equation. Like if you have the experience and you can sell it by yourself without an agent, then go ahead and do it. But I think that, the people that just talk shit on agents just to talk shit is like, maybe you haven't had an experience with a really good one. That's my take.
look, and you look. There's bad agents, just like any industry. There's bad attorneys. There's bad doctors. There's bad everybody. And I think with AI and with all the technology, buying and selling is just becoming easier. So it is going to weed out the bad agents, and obviously the good agents who have their value, their customers know that. So I think that's really where that stands. I don't think, again, headlines versus reality. Guy sells his house on Chat GPT. Okay, it told him to paint and basically aggregated whatever Zillow gave him for his estimate, and he sold it for more than he listed for. What does that tell you? He probably underpriced it.
Exactly. Exactly. Yeah.
So,
It came down to something pretty simple, but
mhm.
no, man. I mean, this is great. Any other topics that you were thinking of that you wanted to go over that sparked interest to you? Because we covered a lot.
Um, it's pretty much it, man. I think there's just so much going on, and again, it really just boils down to this. I think the market started off hot, the economy started off hot, but really just this whole conflict in the Middle East. Once that settles down, and hopefully it's soon, things should hopefully shake back down to normal. Um, Again, it just goes back to, is it a good time to buy a house? That's just not a fair question. I tell people,
Yeah.
everyone's different. You got to do what's best for you. It's like, look, you can't time the market perfectly. How many people I know that bought a house with 6.5% rate, and then 3 months later is down to 6.25 or 6%? It's just like your stocks. If you're gonna obsess over your stocks every month or whatever, I'm down like, what is it, 5% right now, or 10% since the year started. Okay, whatever. This is a long play.
Yeah, unless you're day trading, you shouldn't
Well,
be.
yeah.
I mean, well, that's the thing. Like, that's the
Right.
difference. Is like, are you a day trader or are you a long term buy and hold investor, whether it's stocks or real estate? And like, that's
Yeah,
the
and
thing.
in flipping houses, yeah, you could say I'm essentially a day trader for real estate.
Yeah,
So it is, the small swings are very, um, the metrics are very important. But even still, things usually, real estate is generally slow.
yep.
So when things happen, they're not going to happen overnight. It's usually a trickle down effect.
Yeah, slow real estate is like, when people talk about building wealth and they talk about cryptocurrency and the stocks, and there's like a dynamic aspect of changing quickly. Real estate is long, steady, and it's tried and true, and it's worked if you follow the plan. Which leads me to like my last question. I know that if people want to learn more about you, while you're talking here, I'm gonna go point out the episode that you were on, because like just talking about more your story previously. But what are your goals towards the end of the year with your flipping business? Like you mentioned, you have 15 deals that you're working on right now. I just want to finish up with that. So people that, if they want to reach out to you or learn more about your business, they can do that.
Yeah, I mean, our goal, our game plan is pretty much the same as it's always been. Right now, we have 15 projects ongoing, and we buy houses all the way here in Tampa, where I live, up to Tallahassee. I've got a couple projects going on over there. I'm closing on a new house in Jacksonville on Monday. I don't know if you saw my story. It's a hoarder home,
I saw that. Yeah.
and a lot of the sellers we deal with, a lady calls in, she's like very embarrassed. It was a relative's home, and they had a mental illness, and then by the time we got the house back or whatever, there's just piled with boxes everywhere. So we come in, we say, hey, look, we'll take it as it is, because it's probably, oh my God, it's probably like 10 dumpsters worth of stuff. It's crazy. But that's in a nutshell what we do. I buy from a ton of wholesalers. That's probably 80-90% of my business is buying from guys like that. We do our own marketing campaigns, and we're just kind of all over the place. If the numbers make sense, we're not flipping every home. This could be another conversation. I'm doing a lot of wholesale, and basically what that is, it's between wholesale and retail. Wholesale, you sell houses while they need the work. You're selling them to other investors. Retails, when they're fixed up, you're putting them on the market for a retail buyer who's going to come in with a lender, pay full market value, yada, yada, yada. What I'm doing with wholesale, I'm taking properties that are off market, that aren't really ready for the market, and then we're basically just getting them market ready. Or let me rephrase that. We're getting them fixed up, but we're not doing a whole new bathroom. We're not doing a whole new kitchen. We're basically taking the factors that would prevent them from going to a conventional buyer with a loan and basically making them livable. But we're pricing them at a discount. So it makes sense. If the house is worth 300 fixed up, we're basically taking it to the market at like 250, 260 without updates, but with plenty of equity for people to come in. They want to do their kitchen or bathroom or something, go for it.
That's an interesting way to explain. I actually haven't heard the whole tail. I thought it had to do with like the tail end of not the retail side of it. So I appreciate you breaking that down. So basically, in a scenario like this, if you have a hoarder house, you're cleaning it out and you're painting it or something like that. You're making it livable, right? Maybe you're doing some flooring or paint or something, but you're not redoing all the work in it, and then you sell it at a discount to somebody else who wants to finish that work or do the rest of it, right?
Correct. So basically, we're not stuck competing with everybody else trying to get top dollar. We're typically the cheapest priced property in that neighborhood or in that market. But obviously, again, it's got to be in good enough shape. Nobody's going to buy something that's a total beater. And maybe they would, just depends what kind of price you have. So in a market that's really competitive, that's how we're able to get a leg up on other guys. Because wholesalers, they want to sign the contract. They want the faster money, but they got to parade people in. It's a whole process where I tell sellers, hey, look, I don't need a long inspection period. I'll just walk through it. I'll just close on it, and then I can sell it to another investor from there, or basically control the deal. And that's how I get a leg up on, I just got 3 deals this last month because they didn't want to deal with these other guys that wanted to tie it up with these big inspection periods. They wanted to get 50 people in their showings. And I show up and says, hey, I've seen it. We're good to go. I can close in a week, and that goes a long way to really building trust with a lot of these sellers too. So anyway, you can go check it out. You can check out my TikToks. My wife thinks they're ick, but I think they're pretty
great.
funny.
I love them.
It really gives a good idea of the houses we look at, what kind of situations we look for, and how we navigate them. And that's always been kind of my shtick, is like, I don't need to be like everybody else on social media and real estate. Oh, look at how much we made. Look at this or that. I try to like dial in on, hey, here's how this actually works. Here's some of the things you need to watch out for that I've been burned on. And, here's some of the just wacky, bizarre stuff. I mean, dude, I showed you yesterday, we were supposed to buy a house, and the seller was like in hospice or something, and she literally passed the day before, or the
Went
day
to
of
probate,
closing.
right? Yeah.
Crazy. So now the deal goes to probate, and it's really sad, and you kind of deal with a lot of stuff like that.
Yeah.
But
I remember you and I were in a hoarder house. There was, just walking in there, cockroaches and all that stuff. And it's kind of like I don't know. I like the model that you have. I think it's cool. And I like what you're doing on social. I know you and I have chatted a lot about social media. Just keep posting. It's great stuff. And if people want to check out your first episode, it was episode 257. I can't even believe it was over a year ago. It was February 12th, 2025. The untold truth about wholesaling and flipping with Phil. So go listen to that on our previous episodes, and then go follow Phil at Sunset Home Buyers. That's your Instagram, right?
Yeah, that's my business page, and then my regular one.
Oh, no, Phil Flips Houses. Phil Flips Houses. Yeah, that's where we want to find you. Phil Flips Houses. Yeah, man, this has been great. I appreciate the conversation. I felt like we got a lot covered here, and if people want a state of the market, this is an episode we're going to point them back to until things change, and we have to do another one in probably like 90 days. So thanks for coming on, brother.
Yeah, thanks for having me, bro.
Before we wrap this show up, I want to leave you with this. If you're listening to the show, chances are you're doing pretty well in your career. You're making maybe 6 figures. You're putting money into your retirement accounts, maybe stacking some cash in a brokerage account, but you're still waiting for that next level. And here's the truth. Waiting just costs you time. Every month you're on the sidelines is another month you could have had a property paying you and another step closer to financial freedom that you didn't take. Ryan and I know this because we stayed on the sidelines too long. We talk about this sometimes. We had the money, but not the guidance. And once we finally got our first property, everything shifted. It was the catalyst that built our entire portfolio and ultimately gave us freedom. And that's exactly why we built the Wealth Juice Inner Circle, to cut out wasted time, just give you the exact blueprint and surround you with a network of people who are closing deals every single week. So if you're tired of waiting and you're ready to finally get your first deal, click the link in the show notes and schedule a call with me. Let's map out your strategy and get you moving before another year slips by.